Hello, everyone, and thanks for tuning in, just like you do here every Friday. I'd like to welcome you all to CoMotion Labs Fundamentals for Startups. I'm Brady Ryan, manager of CoMotion Labs Hardware Incubator here in Seattle. If you've joined us before, you know that CoMotion Labs is University of Washington's effort around startup incubation. We operate 3 incubators here on campus: hardware, life science, and a software tech incubator called Startup Hall. Our hardware and life science incubators have specific equipment our members need, like prototyping equipment, lab benches, freezer farms, and so on. And all of our members across our spaces have access to a world-class mentor network, events, office hours, and much more. We don't take equity in your startups. We don't want any of your IP. We just want to help startups succeed. So if you're a founder looking for a place to live, we do have a bit of capacity in a few of our spaces. So let's talk. While we wait for everyone to join, I'll make a few quick announcements. Next week, we'll be hearing from Sharish Nadkarni, board member at TIE Seattle, author and serial entrepreneur, who will present the art and science of achieving product market fit. All of our Fundamentals for Startups presentations are archived on our CoMotion website under innovation training videos, We've covered a lot of topics over the last few years, so feel free to check those out. For our full schedule and to register for future fundamentals, visit bit.ly/CoMotion fundamentals. You can also subscribe to our YouTube channel so you can be notified of future live streams. Lastly, Fundamentals for Startups is funded in part by a grant from the EDA. We will be dropping a link to in the chat to a short survey. This survey helps us keep the EDA on our good side, and so it will give us more money so we can continue to do this. So please take a couple minutes and fill that out just to let us know where you're watching from. Today, Tim Porter is here to present venture capital due diligence, a look inside the investment memo. Tim is a managing director at Madrona Venture Group, a Seattle-based venture capital firm founded in 1995 with $103 billion under management that invests in early-stage tech companies. Tim is focused on investing in B2B software in the Pacific Northwest, particularly in the areas of cloud computing, software as a service, machine learning, and cybersecurity. In addition to his work in Madrona, Tim is a member of the Alliance of Angels Seed Fund 1 and is on the board of the Technology Alliance. Tim was formerly on the boards of the WTIA and Villa Academy. He also serves on the investment committee for Global Partnerships Social Ventures Fund. Tim will take questions in the chat. Feel free to drop those in the bar there, and I might jump in with a few questions as we go along, but I will now turn the event over to Tim.
Thanks, Brady. It's great to be here today. For sure, interject, and if we want to keep this interactive, I would love to do that. Same thing from the audience. Please send in your questions as you have them, and happy to address those. It's funny, Brady, thanks for that warm introduction. I might have heard it wrong, but it almost thought it sounded like it was a Freudian slip around. You said instead of present venture capital due diligence, you said prevent venture capital due diligence, which might be a bit of a analysis on the state of venture right now, and deals moving quickly, and lots of money flowing, and some might say not the same level of diligence that there once was, but that's certainly not a global statement. And frankly, I think the really good firms have figured out to go through all these steps we're going to talk about today, go really deep, be very conscientious and rigorous on diligence, but still do that very quickly, or sometimes even before, really engaging with the company so that they can move quickly to try to win a deal. So that's not going to be part of what I'm talking about today in the timing and how you pull this off and how those dynamics might go, but happy to go there if that would be of interest. And it's been fortunate to be at Madrona the last 15 years and see a lot of companies. I think we have about 3 billion under management, not 103 billion under management, but we do have over 100 portfolio companies. So let's dig in. So VC due diligence and the investment memo. What does Madrona look for in prospective investments? So just to boil this down and keep it super simple, we could just go to Q&A after this, but we look for great founders in the Pacific Northwest that are attacking really big markets. And if we just had to summarize and just say really simply, what are we looking for? That's it. First and foremost, we're betting on and partnering with really great teams. Madrona is focused on, not exclusively, but still far and away primarily, over 80% of our companies have headquarters in the Pacific Northwest, and one or all the founders are based here. going after big markets. We're looking for people who want to change the world, who can create big, lasting companies that have a potential to go be public companies someday and be worth over $1 billion, et cetera. And you need big markets for that. But of course, there's more to it than just saying great founders. But that is the heart of it. So let's dig into it a little bit farther. So VCs in general, what do we look for in early stage investments? And Madrona certainly follows this as well. There's a classic description of it's about team, it's about market, and it's about product. And I'll add a fourth dimension to that as well. And it's really true. We always think about it across those things. Again, team is the most important. We could talk all day about what makes a great founder and some of the things that we're trying to look for in the founders that we hope to be able to partner with. And by the way, I should say, VCs, investors, we try to do a lot of due diligence to understand if it's an investment we should make. Highly encourage founders to do lots of due diligence on their investors. So this is a two-way street, and that could be a topic we wanted to talk more about. So I always encourage, when we're getting to know a team and getting to the final stage of investing, hey, anybody I've ever worked with, please reach out to them. And if you want me to introduce you, I'm happy to do it. If you want me to give you a list, I'm happy to do it, but go for it. You don't have to ask my, permission, just go for it. And most founders are doing that already, but just wanting to both acknowledge and encourage the two-way due diligence, because an early stage investment, leads to a long-term relationship. Our average time we work with a company is about 8 years, and some of them are double that. And some can be shorter, either because it's faster than anticipated to glory, or faster than anticipated to, hey, this just isn't quite working and we should move on to the next thing. But it's a long-term engagement. So in team, it goes without saying but it is worth saying that the first thing we look for is high integrity, and that this can be a trust-based relationship for that long time. And if it's not there, really, you can forget about everything else. And I think most investors are this way. You could show great traction and be super smart and all these other things, and if it doesn't feel like there's the trust and integrity level, then it's just not going to work. There's this other concept that we talked about, I'm going to hit on again later, around founder market fit. We didn't invent this, but it's, why was this founding team, why was this founder, why are they really equipped to go attack this problem in this market? Is it because they lived this problem in their previous life? Were they the customer who was looking for the solution and wasn't there? Were they building, something and realized that there was a business to be created around it? How does it fit where they are in their overall life, et cetera? So that fit between the founding team and the market they're attacking is really important and is really all encompassing. The other, I think, and these are, not necessarily in order of priority, but in some ways they are. The other thing that we were looking for is just very customer driven. Everything that the founder and the founding team does is working backwards from the customer. Some of this talk you'll hear is some Amazonian type aspects to it. That's probably not coincidental. Amazon was one of the very first investments Madrona made back in 1995, and our founder, Tom Alberg, was on the board for 23 years. And so there's definitely a lot of influence there. But we like to work with founders that are maniacally focused on the customer. And, it doesn't matter if your customer is an enterprise, a consumer, et cetera, but you're always thinking through, how can I solve this problem for the customer, and putting them first.
I want to hop in. We hear a lot of founders talk about being, customer obsessed, and we hear venture capitalists say the same thing you're saying, which is that they look for that. Can you give us an example of what that looks like in practice? I mean, is this 1,000 customer interviews a week? Is this, caring deeply? What is, in practice, what do you see that shows you that is there?
So let's say it's a pre-revenue, just getting started company, which is, we invest in a few different stages, from that very formation stage to things that are in the 5 million of ARR. We kind of call that acceleration stage, but most of the time it's sort of this day one, right? Day one for the long run, we like to talk about. And so at that stage, what customer driven means is literally, to your point, how have you done customer validation? How many customer interviews have you done? What are all the different scrappy ways that you've tried to not just go off your gut instinct? Maybe you have amazing founder market fit, right? It's like you were the customer, you knew what you wanted to buy, but how did you test that and not just extrapolate from yourself market of one but go out and talk to N number of other folks. And, that N, more is always better. Big question is when is enough? And sort of figuring that out is part of the art, around this. If you're going after bigger enterprises, maybe it's tens of these interviews. If you're going after consumers, maybe you did a survey of some broader set of things, but that you were really rigorous about, doing that. You documented it. You were thoughtful about the learnings. You were self-aware about the things you didn't know going in, the things that affirmed what you were looking for. You're not subject to a ton of confirmation bias in how you did that. So that's kind of a tangible thing that we look for. And then there's a bunch of intangible things, just the way they talk about their business. Are you talking about, this mega tech trend and this really big top-down market? And, this is how we're going to, attack that. Or are you starting with very much like, hey, here's this customer, they've got a problem, and here's how I solve it, which bleeds ahead a little bit, farther here. Does that get at what you're asking, Brady?
Yeah, that's perfect. Thank you.
Great. Motivation, ambition, commitment, and grit, right? You're going to be wrong in the beginning. And so how do you work past that? I think the alignment of ambition and motive is super important. If your goal is to, build a cash flowing business and run it forever, as opposed to try to grow, within reason as quickly as you can and try to be worth, more than $1 billion and potentially take it public, you should think about that. What type of VC firm do you need, VC, et cetera? And, this is an intangible, but at the end of the day, it's probably, the most important thing, after the integrity piece. Intellectual horsepower, we want people that are smart, who think through the problem from every direction. There's this notion of balance of conviction with a learning mindset. Founders are going to run into a lot of barriers. It's easy to think of the risks, all the reasons why it's going to fail, et cetera, et cetera. And you need to have conviction that we're going to run through all those walls and we're going to win. We're not going to take no for an answer, balanced with, being open to data, being, coachable from and seeking the opinion of people who have, done things before or have other perspectives, hopefully of which we're one of those opinions that you want to, listen to and work with. We're very much not we want to come in and here's our playbook and do it this way. We want to help the founder work in the right way for their business. But you want to make sure that there's this open-mindedness, that they're not just going to run after the most recent shiny object, that they stick to the conviction of their vision, but that you're looking at data and understand where to adjust along the way. And then certainly a founding team matters. I think it's pretty rare that we fund solo founders. There's always a notion of a founding team of 2, of 3, of 4. And do you have a complementary set of skills and personalities, to work across the different functional areas that you'll need to build the business? The other one that I would probably put in customer driven, or maybe I should have put it as an extra bullet, is just good at sales. In sales, probably the thing you do the most as a founder, whether you're selling to a customer, selling to an investor, recruiting your team, recruiting partners. And so the ability to be persuasive, in a high integrity way. It doesn't mean you have to be a salesperson per se, but you have to be able to be persuasive in your vision.
What I don't see there on team is serial entrepreneurs. Is that, I assume that you guys like to see that, but is it maybe not as much of a focus as I would have guessed?
I wouldn't say it's not there on purpose. I mean, we love serial entrepreneurs. We love that some of the people we've funded and companies we've funded have created sort of family trees of, hey, we've got to work with this founder multiple times, or, somebody that worked at this company in the early days now founded their own company. Those things are great because you have a shared learning, shared vocabulary, deep trust. You like working together. At the end of the day, you got to have fun too. So that's terrific. But we also backed lots of first-time founders. I actually used to know the stat off the top of my head. I had worked with more first-time founders than serial entrepreneurs. And so I'd go back to this founder market fit question, point, right? Sometimes the fact that you were a serial entrepreneur strengthens that founder market fit in some deep way. And other times you've got great founder market fit and you've got the grit, you've got the motivation, and this is your first time. So it's not that we don't like it. but that hunger and ambition matters, more, I think, than doing this for your fifth time. We certainly don't want mercenaries.
Sure. Yeah. So Christine asked, she mentioned that a lot of the characteristics you're mentioning around the founders are you can only see it kind of over time. You have to assess it in person, sort of, such as grit is the example she gives. How do you try to suss that out if you're working with maybe a first-time entrepreneur, so you haven't invested in them previously? How do you start to assess grit in kind of the time-bounded and pretty short diligence phase?
It is hard. We try to be careful not to just sort of form too strongly held of opinions based on like one meeting, and that, hey, just because somebody's really good at giving their pitch doesn't mean all of these other things exist, or just because someone, is not amazing at sort of the TED Talk-esque, ability of pitching their company,
Sure.
that doesn't mean they're not an amazing founder and a good business. So, I mean, a few different things. There's no silver bullet. One, we really love to get to know people over time. A fundamental part of our strategy is try to meet founders before they're like out fundraising. A lot of times, even before they found their company, when they're still working at the other company, thinking about the idea, try to get to know each other, try to add some value and give some suggestions, as they're on that part of the journey. Part of it is, of course, through references. We try to do a lot of different references and triangulate, around. And does the person have a track record of, of excellence and have a set of experiences that, that back this up? And then trying to, not just, sit there and going through, spreadsheets of the market or your, details, your engineering roadmap, but go have dinner, go do these different things that you can see, this is a relationship that you could, really, that you could really see being productive for a number of years. It can be hard, certainly higher risk with the, this first time entrepreneur you've never worked with before. You got to really think through that and mutually get comfortable with it. To your point, Brady, another advantage of, working with somebody that you've worked with before and know that rapport is going to be there. But we, I would say, fortunately, in almost every case, it's worked out, that, through this set of processes and conversations that we're able to have, in almost, literally every case have been able to build, long-term, relationships, with these founders we've worked with. Not every business goes and sells for $1 billion or anything even near that. So kind of independent of outcome.
Sure. Great. Thank you.
On the market, a big market is critical for a VC fund who's trying to find companies that can create $1 billion or $10 billion plus, market cap companies someday. Just a very basic kind of, hey, can this company get to 100 million of ARR? If you can, you probably can be worth $1 billion plus, and you can probably have a set of adjacencies and opportunities at that point to continue to grow from there. That's sort of an oversimplified way. We dig into that from a bunch of different directions, but having a large target market's key. You can have great businesses that are, taking share in smaller markets, but they might not be ones that we're able to invest in and be able to construct, a set of returns for our investors and the, $350 million fund that we're currently investing out of. But we also realize that not every market is big today. And we have to have, we use this phrase, a prepared mind for, could this create a very large market? Some of the perfect example are some of the things, in machine learning right now, platforms that are enabling, building intelligent applications for building machine learning models, putting them into production, monitoring them, deploying them, managing them, et cetera. There's this category ML ops we've invested in a lot, and a couple of years ago it was kind of like a $0 billion market that we felt like is, and many other people, there's been lots of investment, it's going to grow very, very quickly and can be a multi-billion-dollar market. And so we try to think about it from both directions. This is a big existing market that you can disrupt and take a lot of share, or is this a market that you're creating, or is it some combination of the two?
Yeah. How big were e-commerce and online book sales in '95?
Yeah, that would be even a more canonical example. Exactly. Macro tailwinds, does this fit within, big trends? I rattled off a few earlier on, this, continued enterprise move to the cloud, digital transformation of enterprises, That are big trends. Are those sort of pulling this business along, and are you working towards those? We talked about customer validation. Who's competition? Do you understand your competition? Do you understand how you can win over time? In this go-to-market strategy one, it's one, if you're at the very formation stage, it could be more in the, hey, we're going to figure this out, but we've got an initial idea. The farther the business is along, the more that we're digging in is really understanding sort of the unit economics of, how much does it cost to acquire a customer? What's the lifetime value of that customer? Do you understand, sort of that trade-off and equation, and how with more investment, can we scale against that? Product does matter, even though I would say it's the least important part of this stool, that I'm talking about, and maybe it's least important in most cases because it's going to have the most iteration, undoubtedly, even though you don't quite know how. We hope that the team is directionally correct, even though they're probably specifically wrong with their initial product. But again, this clear customer pain point in a compelling way to go solve it or need to go solve it. I wouldn't say that every company that we invest in has highly defensible technology or has intellectual property that could be patented, but many of them do, and that's only a plus. So we like the notion of deeper tech. We've invested in about 20 spin-outs out of the University of Washington over the last 20 years, and I think in every case those had deep defensible technology. So it's definitely a very nice thing to have, to be able to, and it's not sufficient, it's not always necessary, but it's a great thing to invest behind along with these other pieces. It's also this notion of create and capture value. So there can be, some classic examples, open source software could create a lot of value for the users, but does the business actually have a strategy for how they then would capture that value in a way that's commensurate with the value that you're creating? And is that a good win-win for both customer and business? Some consumer businesses that involve amassing a large audience, and then, hey, if we have the large audience, we'll figure out how to, monetize this someday. So you don't necessarily, I wouldn't say we only invest in businesses that are like charging immediately. We understand sort of how the power of some of the type of models that you need to build customers, build audience, et cetera, before that enables monetization, but you have to have a strategy for not just creating, but also capturing value. And then this product market fit that we've talked about. And then the last part is context or timing. Timing is everything. For an early stage investor like us, the biggest risk is that we're too early. In that, yes, this is going to happen, but customers just aren't ready, market's just not ready, and this is going to take a lot longer than we might think. And that's, happened in various examples. I was Brady, to your point of trying to create specifics around some of these things, I was having lunch with Diego Oppenheimer yesterday, who founded Algorithmia, who we worked together for 7 years, and they were in the MLOps category. They helped enterprises deploy and manage their machine learning models and applications in production. And they were acquired by DataRobot last year. It was a good outcome. And the whole team went there, DataRobot, it was stock, they're high potential, everyone was happy. But we also didn't quite think we were going to have to sell, and be part of a bigger platform, and sort of like, sure, well, what could we have done differently that would have led to, us being the IPO candidate, instead of being part of DataRobot. And I think, longer discussion, but it boiled down to being really early. We were really early. And in the case of machine learning, as enterprises, first you have to get the data, then you got to build the model, then you have to understand if the models work, then you have to figure out how you put that into an application. Then you have to figure out, do you put that into production? And that's kind of where Algorithmia picked it up, deploying and managing in production. And we were like, man, shifting left, we skated a little far ahead of the puck. So as an example, but still it was a good outcome because of the team. The business dynamics and traction, go ahead, Brady, you're going to ask something?
Yeah, you preempted my question. I was going to ask for a too early and a too late. So what's too late? I assume you guys wouldn't be excited if somebody said they're going to have the new everything social media platform. I mean, are there places that you guys have just decided internally, we're past this, it's too late, this market isn't for us any longer?
Yeah, as I think back on the investments that we made that we quote got something wrong, it's way more too early than too late.
Okay.
But in our discussion of maybe not doing an investment, not infrequently is it like, hey, I think this is kind of late. This space has gotten crowded. Maybe just a specific example. And again, not to say there's no more opportunity in this space by any stretch, but we were investors in a company called Integris that was bought by a company called OneTrust, and they helped companies with data privacy and automating, protecting customer information. And it was ahead of this trend around GDPR. We all know about that. As we click on the bottom of every website we go to, and CCPA. There have been some big companies created there. OneTrust is the company that bought Integris. There's a company called Big ID. And they continue to see companies created around this kind of data privacy automation. And so we've had discussions like, is there more white space there? And what are the new trends privacy and security is one of these things that it kind of never ends. There's always the next thing. But that was one where we've had this discussion over the past year. It's like, okay, were we too early on Integris, or were we right? And what do we think now? Are there more opportunities in data privacy for corporations, or is that kind of market kind of consolidated, around a few of these bigger players, and enterprises kind of have what they need, and now what are they onto next, and thinking about sort of this broader information security world?
Sure. Okay. Thank you.
Yep. I only have this one little bullet in there on business dynamics and traction, which, again, this is oriented towards a formation stage, early stage type company. But your actual business performance, as you start to have them, actual customers, actual revenue, actual, you're acquiring users, are they converting, how much you spending to do that, all those things. We certainly, try to go deep on looking at all those financial metrics, all the different ways you can be quantitative and quantitatively rigorous around evaluating a new investment. At the very early end, you just can't be that quantitative. So we're trying to be as rigorous as is reasonable, but also not to get fooled with sort of the false precision or garbage in, garbage out. You just make a whole bunch of assumptions. You can make anything look good or anything look bad. But that being said, this is key, right? And on our later stage deals, it matters a lot. And do the founders understand their business and understand the levers and understand what's happening? And also, we can sit here and postulate about this market trend and, we think this founding team's great. But sometimes you just are like, look, the proof's in the pudding. I don't know, maybe we underestimated this market or this team, and this is just crushing it, and it's in the numbers. And so that's of course a way that you can get convinced. And of course, there's many growth stage investors that this is like the only bullet on the page, right?
Yeah.
Show me the traction. If you're growing fast enough, we're interested to invest, as long as we can squint and think that this is a really big market. So, we could spend a whole different session on analyzing business metrics and getting to this point. So obviously it's key in getting the time right. Is the business ready to start inflecting and growing even more quickly?
So there's some advice that I've given several times, and I never know if it's good advice or not, to founders when they're putting together kind of that seed stage deck, especially around those financials. And what I always tell them is that it's assumptions on assumptions on assumptions, and it's going to be wrong, and everybody knows that it's wrong, and that's okay, because it seems like the value is understanding the assumptions, diving really deep into your business, and at the very least being able to explain every assumption made and why, and showing the investor across the table that you thought really deeply about it. Is that some of the value that you look for in early stage, way pre-revenue financials?
100%. Great advice. Everyone go back and listen to what Brady just said again. That's good advice. This point I was making about traction, there's one thing about analyzing the actual how the business is doing, but then there's always the forecast, regardless if you're formation stage or if you're, already have a bunch of customers and things. And on that forecast, just to double click on what Brady said, it's wrong. You don't exactly know what's wrong about it. But it's, does the management team understand the drivers and the levers in their business? And it's also just a test around, how ambitious and how big do you think this can be, right? And it's like most VCs, I would be guilty of this. You sort of purposefully sort of set up this this trap as you're talking about, the financials. And as an entrepreneur, you shouldn't freak out, with this question, or not freak out. You shouldn't get frustrated with this question. But it's like, if it looks like it's really aggressive, you ask the questions like, gosh, this is crazy aggressive. Few businesses in the history of the world have ever grown this fast. Why do you think you could possibly grow this quickly? And if it's too conservative, then it's like, well, wait, don't you have conviction in the business? Why don't you think it could grow faster? What could make it grow fast? We try to ask those questions in constructive ways, of course, because we want to sort of be in this together. But that's the type of thing that the forecast provides a good tool to talk about, right? How fast could you grow? What are the bottlenecks? Do you understand the bottlenecks? Could we remove those bottlenecks? Or on the other side, it's like, oh gosh, I love that you think there's a huge opportunity, but hiring, going from 1 salesperson to 10 salespeople in like 1 quarter is just not a good idea. That's just a way to waste a bunch of money. Sales learning curve. You start with 1, salesperson. Now let's hire 2 or 3 more. See how that goes for a quarter. Walk before you run. So lots to talk about there, but that's a great point. The financing markets also matter. If there's something you love and it's a category that's out of favor, it's the best investments, turn out to be the ones where you're contrary and right. And so it's, we never try to, you want to lean into opportunities you have conviction around that are contrary, but you need to also understand that's like, hey, if I have this contrarian view that this online advertising business is going to be huge, like, why do you think that? And that almost every other investor is not investing in online advertising right now. So why do we think that? So that's part of the discussion on financing markets. And then, the last one, cash requirements. I mean, this is the key substantive thing. Is there a meeting of the minds with the founders around how much money do I need to hit a set of milestones to build this business in kind of a durable way? And that it's not just like, well, we're raising 25 million because we were told that's what a good Series A is these days. Yeah. Or like, hey, we want to raise 3 million. What do I call that? It's like, well, who cares? Call it whatever you want. Yeah. Why do you need 3 million? And is that actually the right amount? And are the investors you're talking to a good match for that amount of capital? That's the way to think about that. And on investment terms, there's absolutely at early stage a real, philosophy that, venture returns are governed by power law and huge winners. And so, whether the initial valuation doesn't really matter. On the other hand, there's always that it matters within reason, for both the founder and the investment firm. And so we care about it, right? I think that as we think about fund after fund after fund and wanting to provide, 3 to 5x, cash on cash return for our investors or better in every fund, then you can't just pay any valuation and hope that you just funded the next stripe. You do hope that you funded the next stripe, and that will make your fund and that will provide those outsized returns. But over the course of an entire fund, having some degree of discipline on valuation, we think matters, but also to not be penny wise and pound foolish. If this company turns out to be $1 billion company and we didn't invest because we thought should have been a 16 valuation and the founder wanted a $25 million valuation, boy, that was a bad decision. And how are you going to go explain that to your investors? And you're really going to regret it.
So how quickly is that model, like that mental model that the partners around the table have, how quickly is that evolving around kind of reasonable valuations? I mean, we've seen valuations go pretty crazy over the last 3 years, right? Are you all checking in monthly and seeing? Oh gosh,
it's really every week. I mean, and it's art, and it has been really dynamic. Just an anecdote that might be fun, Brady. So I was at Amazon Web Services reInvent conference. I think it was first week in December. I was talking to another VC who also does early stage, and we've worked with a lot, and who's been super successful, and was talking about, hey, for our kind of formation stage strategy right now, we're just going to go in with this dollar check for this percent, because before we were trying to go for this other percent. So I mean, I don't think I'm giving anything away. It was like, we're just trying to get 10% now, where before we thought we needed to have 15%. And it was like, well, why did you make that change? It's like, well, 15%, that was so May, right? And it was like December, right? It's like, and then from reInvent to now, at the late stages, all the growth stage company valuations have come down between 30 and 50%, right? So it was huge, change there too. So at the late stage, very late stage, I think the companies get priced more in line with what's happening in the public markets, and the earlier you get, the more disconnected you are. And there's different dynamics, for instance, as more money has flooded into the very early stage, that's moved valuations up, even as late stage valuations have started to come down. So there's a lot there, that we could talk about, but we think about it a lot. It does also come back to this: how big do you think the market is, right? Like if you're saying like, gosh, we thought maybe 3 years ago this would be a, $40 million pre, and now it's a $140 million pre. We still love the opportunity and we still love the founders, but like, do we really think that, now to get to our, 5-10x return, you can't just get to 400 or 500 million. It's got to get to $1.5 billion. How many, anyway, it a lot of times comes back to how big can it be and is the market supportive of it? And I've talked about this with some other friends in VC too, focused on late stage. Some of these companies where it's like, gosh, that valuation seems so expensive. And then 2 years later, it's like, man, that seemed cheap. We should have done it. The thing that you got wrong was just how big the market was. And the size of some of these markets, whether it's consumer or enterprise, and how quickly you can scale to access those, and then things like consumption-based models that the companies like Snowflake have taken advantage of, all have created, with the right product team market, the ability to grow really large, really quickly.
I love this slide. There's a few questions from the audience that I want to get before we move past this.
Cool.
Arcady asks, for a software app development startup specifically, what sort of skill sets are you looking for in the founders? For
a software, say one more time, what type of business? Basically building a software application?
Yes.
Yep. Well, I think initially does the team understand the customer and the problem? I've talked about that a lot already. And do they know how to go build it, in a scalable way? If there's not sort of the go-to-market person on the team, sales or marketing initially, that's often something we're like, hey, we can help you find that, person. We can try to augment that part. Occasionally it's the other way around, where there's a business team who's got a great idea and they know there's a pain point and they researched it, but they need to find a strong CTO type founder who actually knows how to build it in a scalable way. So I think those are the initial things. It's usually like, is there a strong technical team? Have they really validated the customer problem? Usually suggest having a product manager type, if not on the founding team, but very early. Because even though maybe the technical founders are they're the product visionaries, but just all this ongoing work of validation, voice of the customer, outbound back to what you're building before you're even ready to have a salesperson or a sales model is something that we encourage.
Okay, we got somebody asking, what is your approach? And I know Madrona is Northwest-ish focused, so this might be go talk to somebody else, but what's your approach toward non-US registered startups, especially the ones with a team based in countries like Ukraine? Any special tools or multipliers for them?
Well, our expertise is not in investing in companies headquartered overseas, whose predominant initial go-to-market, would be focused on those international markets. On the other hand, many of our companies, are distributed from day one now, or, not uncommon. In fact, if we get to it, I was going to talk about one of our investments here a little bit. They started out in day one with a team in India and a team in the US. It was a US headquartered company, but the team is built almost one for one, in this case, Indian here. So if you have some sort of like relationship or almost proprietary ability to build a great team in some other non-US location, generally we view that as a huge positive, because let's say it's just people that are in Seattle going like, gosh, we know we would love to access some of the great, engineering talent in some of these other countries, save money, get their insights, etc. We just don't know anyone. That's a tough nut to crack. It almost never works. Like you have to have somebody with some experience and feet on the ground. So generally a plus. But if the question was specifically like, would we go invest in a company headquartered in Ukraine? The answer would be no, just because we don't do that. Same thing if it was in China or if it was in, Ireland.
Sure. And then quickly, what do you, this is a big question. How are you thinking about Web3? Is it already crowded?
I am not our expert on Web3 to the extent anybody's an expert. It's definitely not me. I'd say we are, I think it's both a ton of potential and super crowded, if it can be both. And yeah, longer conversation. I think there's parts of, we're probably spending most time looking at some of the enabling infrastructure technology that can create different applications and enable blockchain, et cetera. We certainly haven't gone as much, we haven't gone at all specifically into currencies or specifically into NFTs. So there's certainly places of, massive amount of hype that seems to be ahead of the opportunity. But on the other hand, I think there's a lot of long-term opportunity. So I don't know, kind of a non-answer, but you need more time than we have and someone other than me to go deep in that one. Keep going. Great. Just quickly, one other way to look at this, and I full credit to my partner Matt for thinking about this around this notion of founder market fit and the trail of whys. And so, this idea of what we look for, it's really, again, it starts with the founder. Nothing else matters if not for the team. And, we're trying to just be helpers to those founders to go create, great companies and capitalize on their vision. So this question of like, why them, why us, which we've just talked through, in a lot of depth and what we kind of look for in founders, even though there's no one size fits all. And then there's the, what's the problem you're solving? Why do this? Why is this a problem worth solving? Why is it a pain point? Why would it be interesting to go do this? And then it's sort of like, well, why this? Why this solution? Can you actually build this product? Is it a feature or is it a company? Is it defensible, et cetera? And why now? All the macro trends we talked about. Do you have tailwinds? Is this the right timing? Is this a big market? And then I kind of think of this, is it an exciting market? Both it's a function of the problem you're choosing to solve and the macro forces that are sort of pulling you along. So I thought that might be another interesting, kind of founder-centric way that we think about this when we talk every day. Okay, so we're going to talk about investment memo. So every VC that I'm aware of, before they make an investment, there's some way that they summarize their diligence and their recommendation and share that with their partners. I guess some firms I've seen do big PowerPoint decks, but in almost every case I've seen it's actually a narrative memo. That this is what Madrona does. It's like, well, why a narrative memo? All the reasons why Amazon writes 6-pagers and probably most of you have tried to do it. We just find that actually having to put it into narrative is the best way to explain to the partnership what the company does and why I think you should invest and demonstrate that you've thought through the risks. I also find it hugely clarifying in the process. So the process of writing the narrative memo is as valuable or more valuable in many cases than the actual output. It just makes you think, have I thought this through from every angle? Is the thinking clear? Are there other holes? And having to put something down in narrative, maybe this is obvious, is a really great way to do that. I've even talked to kind of solo investors, angels or single GP funds, and they still write a memo. Even though it's sort of like I'm writing this memo just to myself. I don't have to convince my partnerships. I just have to decide. But I still think that this is a great rigor to enforce. And then the last piece, it's a lasting artifact, right? And so if you wanted to explain to somebody else or somebody came on the team, this happens all the time. We had 5 new people join our investment team over the last 6 months, and asking about a company or why do we do this or that. It's like, well, here's the memo. Just read it. And then even more substantively, when the company comes back to raise their next round, to be able to look back and say, what was our initial thesis? What was right about it? What was wrong about it? Did they make progress? Did they hit their milestones? Okay, those weren't the milestones. Instead, it was different milestones. And they hit those. It just provides a baseline, right, on your thinking, and sort of also helps you with are we just kind of, drinking our own Kool-Aid? I don't love that analogy, but to sort of have an actual baseline around what did we say was going to happen, and now are we, sticking to that, or what if we're changing, why? And now let's be intentional about that.
I was curious, how often, if ever, does Madrona kind of go back over 2, 3, 5-year-old investment memos of either deals you passed on or invested in, just to see, hey, have we been systematically evaluating market size wrong, or have we been systematically evaluating technology risk wrong, and kind of use that feedback after there's been some time for the company to operate for a while to kind of hone your model?
That's an awesome question. We definitely go and do postmortems on our own investments. whether it went well or especially if it didn't go well. And that includes going back to the original memo and it's like, what was off in our original thesis? Or, a lot of times like, hey, our thesis was pretty good and we just, didn't collectively execute, well enough, of which is, we share responsibility for. We also do postmortem in terms of looking at like all the deals that got done in the Pacific Northwest and, the ones that we didn't do, why didn't we do them? The ones that we tried to do but lost, why did we lose? The one, et cetera. That's less about going back and looking at every memo because the memos tend to be kind of sparse, right? We do a lot of them, but most of the time we write a full memo and bring the company in, it's actually pretty darn high hit rate of actually doing that investment. For sure, us saying yes to doing that investment. The process of writing the memo also and all this diligence we're talking about involves a lot of team sport activity inside the firm. You're vetting things, you're getting other people's opinion, et cetera. So once the memo is totally done and the company comes in to give their presentation, hopefully that's capping off, the recommendation. The other part, Brady, where we definitely do it is when it comes time to the follow-on, which I referred to, in that sometimes if the follow-on, like the company's doing great by all measures and there's a new lead and everyone's super excited about it, and it's moving fast, I won't tell you that we sit there and write like another 15-page document, every time. We can have a discussion. We've got the board decks. We talk through all those things. We want to do our pro rata. That's our strategy. We want to keep investing, along the way, maintain or increase our pro rata. Sometimes it's more gray, right? And sometimes we don't do inside rounds a lot, but you do them. In fact, sometimes when having that conviction to double down, even in the face of some adversity, can create the best outcomes. Our investment in Smartsheet, we've talked about this before publicly. It's a $10 billion market cap now. The company almost, their second round, was the founder writing a check and us writing another check that actually was at a lower valuation than the first round. And nobody else wanted to invest at that point in time. And that's always a really hard decision because, you could take the point of view that if we can't get anyone else to invest, why the heck should we? We're just fooling ourselves. But if you just did that every time, then I think you're missing, opportunities where you work more closely with this team and you've got the conviction along with them and you have some insights. Let's keep funding it. Anyway, long story short, going back to that initial memo and even having a different team inside Madrona help write the next memo. So it's not just the person who's so close to it on the board or whatever. We really use that original memo as kind of a stepping stone to then, taking our thinking forward.
I love that Smartsheet story because that is a great example of that kind of contrarian thinking where the contrarian bets when you're right are the biggest payoff. And that just feels like that would be so hard to navigate when kind of the whole venture community is saying like, no, but you still have that conviction in the company and it's a down round and the optics are bad and all that. But, it's
really when you have to rely on your partners too. And why I think in general, most firms are partnerships and not, solo or not, CEO command and control down with one person kind of making a decision. Because Smartsheet was amazing. We're so happy we did it. It was the biggest, dollar return in the history of the firm. Other examples where we doubled down in companies that it didn't end up working, right? And it's like, well, that was good money after bad. Why didn't we? And yes, we want to be side by side with our founders and not give up and persevere and have that conviction. So that's where all of our heart and everything around it is. But when you do fund something one or two more times and it doesn't end up working out, then everyone looks back and says, was that a good use of time and money? It's not just investor money, right? It's opportunity cost for the founders and things too. And so it's one of the hardest things to get right is when to double down versus when to say, hey, we just didn't quite get something right here. Let's try to go sell the company instead.
Sure.
Should I keep going?
Absolutely.
So I didn't mean for this to be this big build of all this, but so these are generally the sections that we try to cover in a memo. Provide background. Always start with the investment thesis. Kind of what are the 3 to 8 bullet points of why we should make this investment. We then try to follow it immediately, in the reading of what are the risks, what could go wrong. We think about sometimes in the context of what's our pre-mortem. If this didn't work, what do you think would be the reasons why it ended up not working? And then these next sections, we don't always write a big thing on all of them, because we try to also dial into, well, what's the most important question for this business? Is, there definitely a defined pain point? We're just not sure if the market's big enough or if this market will grow into big enough. If so, how do we really get comfortable and analyze that? Is it like, hey, we think this is a great market and a great team, but are we too late? Is there too much competition? So we try to really, not obviously, we don't just fill this out because we're handing it in to our, to a class. You're trying to really hone in on the questions that matter and focus there, and not as much on the others. And sometimes it all matters. And we do have kind of this notion of in each memo where across these areas, we try to give kind of a summary green, yellow, red kind of assessment across these key areas. So kind of narrative wise, we write this out. And then we give this as a summary to kind of, for completeness, show how we sort of think about it, and give it the scorecard, which is also a great thing to refer back to.
I'd love to know kind of who the cast of characters is on your side, everything that goes into that. I mean, how much of that is being produced by analysts, by partners, by MDs? Who all touches that process? Yeah,
great question. We generally work in teams of 2 or 3 that are kind of the deal team. And we, in almost all cases, take a board seat, not because there's some magical governance control thing about being on the board, but just because we want to spend time and roll up our sleeves and really help. And so there's whoever is kind of sponsoring the deal, who would be the board member if that was going to be a thing, plus generally one of the people on our investor team. And sometimes there's another person as well. Then we try to involve the rest of the firm, as I talked about. We view it as a team sport, right? And kind of making sure we're asking the right questions and bouncing things off along the way. Brady, we have a philosophy that everyone's an analyst in Madrona, and we didn't invent that. We actually heard a later stage firm that we respect a lot say that recently. So that memo, I wrote it, right? I like typed it up. I made the spreadsheet. Other cases, there are somebody else in the team that's typing up parts of it, that's doing analysis. For us, it's kind of all hands on deck on, how do we divide this up and make sure we're getting to the right data to answer the right questions that people have. We definitely have, what would be traditionally called a principal or an associate on our investor team, who often takes point on pulling all of that together into the investment memo and probably runs more of the models and does more of the writing than people who are, on the, the managing director side. But we are very cognizant to be flat, and that we're always all, are an analyst. And that's how we kind of approach thinking about these things, and that we're all rolling up our sleeves to work together.
That's great. We are getting close, but there's several good questions still. Quickly, you mentioned that there's more money flowing into early stage now. Are you seeing more money than valuable companies, hence inflating valuations? Do you think that's the key driver, that there's just so much capital out there driving up valuations? Or do you think companies are inherently more valuable at earlier stages?
I think there's a ton of money, and that is driving up valuations. Now,
Great.
Full stop. There's more subtlety to it than that, right? There's this notion of like, when a company is deemed to be hot, either for, because it's got amazing traction or it's got hotshot founder or whatever, then there's I think a feeding frenzy that even drives more capital and higher valuation to that. And there could be other companies that's quite worthy and doing well, but maybe, so there's always sort of this barbell, the have nots, unfortunately. So I don't want to say that there's purely more money than there are good companies, because I think there's also good companies who still in this environment, aren't finding it as easy as they read about in TechCrunch. But there is a ton of money chasing deals.
Okay. Last question. So on the timing side, how quickly can a deal come together if everything's right? So startup reaches out, they are about to close or hoping to close soon. They have their whole deal room together. Hot deal. How quickly could you guys get a check written? And what is kind of the more median time frame for that?
The fastest can be, days. We actually had one in December that, there had been interaction with the founding team, for leading up to it, but the whole like, hey, we're fundraising now, went super quickly. And, deal team had done some work. They had a meeting. They did a quick write-up. It was on a Friday afternoon. They sent it to the rest of the firm. We're like, let's go do it. And they got the term sheet signed that weekend. That happens. Median is probably 30 days. that you probably, 3 weeks, you kind of go through, you have a meeting, you do some work, you have another meeting the next week, you do some more work, you schedule the partner meeting, you write the memo, you bring them in. That takes, 3 weeks usually. I would say the big event is signing the term sheet for us, because after that, it's just like mechanics. We're not doing more diligence, but that, can take anywhere between a week and a month, to actually fund it too, depending on the company side, et cetera.
And very last, how can folks get a hold of you or Madrona if they want to talk?
Yeah, it's actually not that hard. My email's on the website, tim@madrona.com. Tweet to me, send me a message on LinkedIn, send me a note. I'm not always as good as I want to be on replying, but we'll definitely try. Our bias is to take first meetings, build those relationships. Maybe it'll lead to being able to invest now. That would be awesome. We would be so excited. And the odds are that it might not be right this time, but it might be down the road. And so please reach out, and I'll also can help get you in touch with the right person. If you're writing about Web3, I'm probably not going to meet, but I'll probably introduce you to Maria, on my team, for instance, on our team.
Well, that's all. And thankfully, a piece of equipment just shut down, which was nice. It was very loud in here until a second ago. Thanks everybody for tuning in. Tim, thank you so much for your time. It was great to kind of see a behind the curtain look at the investment memo and kind of begins the due diligence process. So we really appreciate that. As a reminder, next week at noon, next Friday, we'll be hearing from Sharish Nedkarni, who will present the art and science of achieving product market fit. Please sign up for that, and we will see you all next week. Thanks so much.
Thank you.